Hello everyone and welcome back to Math and Maticians. Today, we bring you the first episode of the QuantScore Financial Show, where we break down market trends and provide weekly undervalued and overvalued stocks based on algorithmic predictive trading models. This episode will be evaluating stocks and companies for the holiday trading week of December 23rd, 2024, with financial data from after the closing bell on Friday, December 20th. We'll be looking at QuantScores, a system we developed to identify potentially undervalued and overvalued stocks. Each company's QuantScore is based on the comparison of the predicted stock price of the different algorithmic models versus the actual stock price of said company. Simply put, the higher the QuantScore, the greater the opportunity for the price to move, either higher or lower. QuantScores do not represent an instantaneous expected change in the stock valuation of a company. Instead, the QuantScores produced by our algorithms are simplified predictions, then monitored and further evaluated by Math and Maticians. But stocks can move in a variety of ways. Although we may believe a stock is under or overvalued, that does not mean the stock will reflect our belief in any way. With that said, stocks are nearly impossible to predict. Other than some of the best quantitative financial managers in the world, struggles to reach a 20% average yearly return, let alone beat that number. Plus, the research resources available to these hedge funds are astronomical, and their assets under management in the billions. Investing in a safe S&P 500 index fund such as State Street's SPY, Vanguard's VOO, or Fidelity's FXAIX will always be your best and safest option for investing. With that said, Math and Maticians and the QuantScore Financial Show are not financial experts or financial advisors, nor claim to be. And the information on this channel is not meant to be used as financial advice, but instead for entertainment purposes and to progress financial knowledge and information. Now let's dive into our undervalued stocks of the week. First up, we have Dollar General, ticker symbol DG. People are always looking for a bargain, and that's where Dollar General thrives. Dollar General is currently down 41% in the past 6 months, and we believe there is major opportunity for recovery. DG currently has a price-to-earnings, or PE, ratio of 12.19. They also have a return on assets ratio, or ROA, of 4.25%, and provided investors with a return on equity ratio, or ROE, of 21%. None of this information would suggest to us a 41% decline in the stock price over the past 6 months. Plus, Dollar General has been strategically expanding its footprint, opening new stores in both urban and rural areas. So, while Dollar General has taken a beating of the past year, we believe their QuantScore suggests it could be a potential opportunity for investors. Next up, we're heading east to talk about Baidu, often referred to as the Google of China, with the ticker symbol BIDU. Now, Baidu has had a bit of a rough year, with its stock price taking a hit. Baidu is currently trading at $85.80, approximately $7 above its 52-week low. In addition to their strong earnings ratios, current and forward, we believe their 6% quarterly earnings growth for the last quarter is going to be further compounded on moving into the holiday quarter. And with a QuantScore of 16, our algorithms are signaling a potential undervaluation. We're talking about a massive user base with a growing middle class that's increasingly reliant on online services. But Baidu is more than just a search engine. They're heavily invested in artificial intelligence, cloud computing, and autonomous driving, all high-growth sectors that are expected to boom in the coming years. So if you're looking for exposure to the Chinese tech market and have a long-term investment horizon, Baidu's QuantScore suggests it might be worth a closer look. All right, let's shift gears and talk about a company that's been delivering packages and value to investors, United Parcel Service, also known more commonly by their ticker symbol UPS, coming in this week with a QuantScore of 12. Now, you might think of UPS as just a boring old delivery company, but there's more to them than meets the eye. First off, the e-commerce boom isn't going away anytime soon. In fact, it's only getting bigger. And guess who's handling a huge chunk of those deliveries? You got it, UPS. UPS is currently down about 10% on the month and has dropped even further from its 52-week high of 161.48, making it a great opportunity for everyday investors. But UPS is not just about delivering packages. They're also a logistics powerhouse. They've got a global network of planes, trucks, and warehouses, and they're using technology to optimize their operations and become even more efficient. And here's something most people don't realize. UPS is also a major player in the healthcare logistics space. They're transporting temperature-sensitive pharmaceuticals and medical devices, a market that's only going to grow as the population ages. UPS also has an extremely attractive price-to-earnings growth ratio of 1.579 and a return on equity, or ROE, above 31%. So if you're looking for a company with a wide moat, a solid dividend, and the potential for long-term growth, UPS's QuantScore suggests it might be worth considering. Let's talk groceries, specifically Albertsons. Ticker symbol ACI. Coming in this week with a quant score of 12, everyone needs to eat, making groceries recession-proof. And Albertsons isn't just any grocery store chain. They own Safeway, Vons, and Jewel Osco. Sadly, there is not too much numerical excitement for Albertsons, but what they excel in most is consistency, and we strongly believe that consistency is currently being sold at a bargain. Somehow, our first three undervalued stocks have had quite a dramatic year, and Albertsons is definitely another. Albertsons' recent failed merger with Kroger seemed to have been an outcome Wall Street had long since anticipated, and something we agree with here at Math and Maticians. But that is not to say Albertsons is not undervalued. Kroger was set to pay $27.25 a share for Albertsons, and while we believe the stock will not get to that point, we do see the stock reaching the range of 24 to 25, an approximate 20% increase. ACI's quant score suggests it might be worth adding to your shopping cart. Hold on to your Mickey Mouse ears, folks, because we're diving into Disney. Ticker symbol DIS. Disney needs no introduction. They are the kings of entertainment, with theme parks, movies, and streaming services, and so much more. But Disney's stock has been on a roller coaster ride since 2020. Disney has seen a considerable rise over the past month or so, but our algorithms believe there is still much more magic in those famous years. Disney Plus has been a massive success, attracting millions of subscribers. They're investing heavily in original content. Their theme parks back to full capacity, although their PE ratio may be a bit high at 40.94. We do believe that is a reflection of the extreme diversity across their businesses, and a small caveat is Disney's price-to-earnings growth ratio is a remarkable 0.98. Disney's quant score suggests it might be a magical addition to your portfolio. Lastly on our list, we have an honorable mention of the week. Although this might not be a normal undervalued stock for us, we would like to take a minute to highlight Advanced Micro Devices, better known by their ticker symbol AMD. AMD started the year on fire with its stock price soaring, but has been seeing consistent decline in the past 4 months or so. They're the main rival to Intel in the CPU market, stealing market share with their Ryzen processors. AMD is also a major player in the GPU market, competing with NVIDIA. We believe AMD's stock has partially mirrored that of NVIDIA, rather than being more strongly priced on metric. But their Radeon GPUs are a favorite among gamers and professionals. As the gaming industry booms, AMD reaps the rewards. As for their financials, AMD's PE ratio is higher than some GameStop bulls at a scary 105.2. But the metrics that are bringing the company to life are their staggering price-to-earnings growth ratio of 0.314, a quarterly earnings growth of 161%, and a quarterly revenue growth of nearly 18%. If you believe in AMD's growth, their quant score suggests it might be a chip worth betting on. All right, let's switch gears and talk about our overvalued stocks of the week. First up on our list, a company that's synonymous with the internet. GoDaddy, ticker symbol GDDY, with a quant score of 38. Now, GoDaddy is the world's largest domain registrar, but our algorithms are flashing a potential overvalued signal. So why is GoDaddy raising eyebrows? Well, for starters, the domain name business is getting increasingly competitive. There are tons of players out there, all vying for a piece of the pie, which puts pressure on pricing and margins. Plus, GoDaddy's core business of selling domain names isn't exactly a high-growth market. I mean, how many New websites are being created every day. It's a mature industry and growth can be hard to come by. Now, GoDaddy is trying to diversify its offerings by providing web hosting, website building tools, and other online services. As for GoDaddy's financials, their PE ratio and price-to-earnings growth ratios are both solid metrics for the company. But will they really fall short? Is their high forward PE ratio? We mainly believe GoDaddy is overbought, believing it should be trading closer to its August price of approximately $160. So, while GoDaddy is a well-known brand and a dominant player in the domain name space, their high QuantScore suggests that at their current valuation they probably are not the daddy to go with. Let's talk about everyone's favorite food delivery app, DoorDash, ticker symbol Dash, with a QuantScore of 29. Now, DoorDash has been a Wall Street darling since its IPO, but our algorithms are hinting that its high-growth days might be numbered. So, why is DoorDash flashing warning signs? Well, for starters, the food delivery market is getting crowded. Uber Eats, Grubhub, and even Amazon are all vying for a slice of the pie, leading to intense competition and pricing pressure. Plus, DoorDash's profitability has been a concern. They're burning through cash to acquire customers and expand into new markets, and it's unclear when they'll be able to turn a consistent profit. Most of their financial metrics are negative, their only financial positive being a quarterly revenue growth of 25%. Not nearly enough to explain the stock doubling from last year. So while DoorDash is the market leader in food delivery, their high QuantScore suggests that at their current valuation you may just find them dashing off with your investment. Let's talk about a tech giant that's been around for over a century, International Business Machines, better known by their ticker symbol IBM, with a QuantScore of 22. Now, IBM is a behemoth in the tech world, but our algorithms are suggesting that its best days might be behind it. So why is IBM raising concerns? Well, for starters, they've been slow to adapt to the cloud computing revolution. While companies like Amazon, Microsoft, and Google have been gobbling up market share in the cloud, IBM has been playing catch-up. Plus, IBM's core businesses like mainframe computers and IT services are facing secular decline. These legacy businesses are generating cash, but they're not exactly growth engines in the 21st century. Now, IBM is trying to reinvent itself by focusing on hybrid cloud and artificial intelligence, and although they have seen a strong increase in earnings, their revenue growth has been nearly non-existent over the past quarter. So while IBM is a massive company with a long history of innovation, their high QuantScore suggests their market value rode the AI wave upward without substantial justification. Let's talk about a company that's at the heart of the financial markets, Tradeweb markets, ticker symbol TW with a QuantScore of 21, but our algorithms are hinting that its stock might be a bit pricey. So why is Tradeweb raising eyebrows? Well, for starters, the financial markets are cyclical. When the economy is booming and interest rates are low, trading activity tends to be robust, which is great for Tradeweb. But when the economy slows down and interest rates rise, trading activity can dry up, which can hurt Tradeweb's bottom line. Plus, Tradeweb faces competition from other electronic trading platforms, as well as traditional banks that are trying to modernize their trading operations. This competition can put pressure on pricing and margins. So, while Tradeweb is a well-established player in the electronic trading space, their high QuantScore suggests that at their current valuation, we believe it should be traded away. Let's talk about a European software giant, SAP, with the same ticker symbol, with a QuantScore of 20. Now, SAP is a global leader in enterprise resource planning, or ERP software, which helps businesses manage their operations. But our algorithms are suggesting that its dominance might be waning. So why is SAP raising concerns? Well, for starters, the ERP market is mature and growth is slowing. Most large businesses already have ERP systems in place, so SAP is increasingly reliant on selling new products and services to existing customers. Plus, SAP faces competition from cloud-based ERP providers like Salesforce, Oracle, and Workday. These companies are growing rapidly and stealing market share from traditional ERP vendors like SAP. On top of that, their financials have been abysmal at best, with a PE ratio of 101.11 and a return on equity of only 6.5%. So while SAP is a large and profitable company with a loyal customer base, their high quant score suggests that their current valuation, we believe their market valuation, is more reflective of a sapling rather than a fully grown pine tree. Let's talk about a company that's riding the mobile gaming wave, AppLovin, ticker symbol APP, with a quant score of 50. Now, AppLovin provides a platform for mobile game developers to grow their businesses, but our algorithms are flashing a big, fat, overvalued signal. So, why is AppLovin raising red flags? Well, for starters, the mobile gaming market is notoriously fickle. What's hot today could be old news tomorrow, and AppLovin's fate is tied to the success of the games on its platform. The exponential rise this year seems unjustified, at least at its current price and financial metrics. Although AppLovin's metrics are all strong, we believe a 3x increase over a 4-month period is slightly beyond belief. Plus, AppLovin faces intense competition from other mobile gaming platforms, as well as from the game developers themselves, who are increasingly looking for ways to bypass middlemen like AppLovin. So while AppLovin is operating in a fast-growing market, their sky-high quant score suggests that their current valuation is detached from reality. That's it for this week's episode of the QuantScore Financial Show. We covered a lot of ground today, from undervalued gems to potentially overvalued traps. Remember, these quant scores are just a reflection of algorithmic prediction models used for entertainment and educational purposes and should not be taken as financial advice or utilized as investment tools. It's crucial to do your own research, consider your risk tolerance, and make sure any investment aligns with your overall financial goals. Don't forget to like this video if you found it helpful, subscribe to the channel for more market and mathematical insights, and hit that notification bell so you don't miss any future episodes. Thanks for watching, and I'll see you next week. Thanks again for tuning in to our first episode of the QuantScore Financial Show, brought to you by Math and Maticians. We're excited for you to join us on our next mathematical journey. Stay calculating, my friends.